Life insurance is one of the most powerful assets in the world. Unfortunately, what I find in most of the conversations that I have with people is that most people don't understand all of the different moving parts and the different ways that you can leverage a properly designed life insurance policy in your life to increase your financial efficiency and ultimately help you reach your goals on a more predictable basis. So in this video, I'm going to endeavor to communicate and share with you the 5 reasons that I love whole life insurance and the different ways that you can utilize it and leverage it to increase your financial efficiency in your life, get your dollars that you spend on your life insurance premium to perform multiple functions, multiple duties in your life. And ultimately, I think when you get to the end of this video and you understand all those different things, you'll have more clarity and ultimately, hopefully, you will see the value in this. If you have any questions, as always, make sure you leave them in the comment section below. If you haven't already, subscribe, hit the bell, that way you're notified every time I launch a new video. Can't wait to see you in there. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we're gonna be covering the 5 reasons I love whole life insurance and the ways that you can utilize life insurance, or the reasons that I believe life insurance will help you ultimately reach your financial objectives faster. Now, I say this in a lot of videos, I'm gonna say it right now. Properly designed whole life insurance policy is the only financial tool, financial product in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. Now, with that said, obviously we all have goals. We all have things that we want to accomplish in this life. Everybody kind of lives a different life. I'm married, I have 3 kids. A lot of people are single. A lot of people are at different phases of life. Their kids have kind of grown up and flown the coop. They're no longer in the house, and you're empty nesters. And maybe you have a different need or desires that you have with your legacy planning, that you have with your retirement planning, that you have with your need for an emergency fund, that you have with any kind of opportunity fund that you may want to have, as far as like investing in different things like real estate or businesses or whatnot. So at the end of the day, what I want to go through in this video is kind of going through all those different phases and kind of take all those things into consideration as I go through these 5 elements. And the first one that I want to get into is the death benefit, the tax-free death benefit. Now, I know a lot of times when I talk about life insurance, and when a lot of people around the internet right now are talking about life insurance, especially when it comes to cash value life insurance, we like to focus on the cash value. We like to focus on the liquidity and all those different things. And believe me, I'm going to get into that. But let's not forget that this is life insurance. And when we talk about our options, and when we talk about the fact that it is the only financial product in the world that will make sure what you want to happen, when you want it to happen, whether you're here to see it or not, right? When we think about it through that lens, and we think about, all right, what are our alternatives? We know we need to save money. We know that we need to put money in a place that is accessible to us for all these different reasons, for emergency or whatnot. And once again, I'm going to get into that. But the bottom line is, if I go and save money and I put money in a bank account and I'm saving up money to meet my emergency fund, maybe I'm following Dave Ramsey, even though I would advise against that from a lot of different angles. But let's just say you were saying, all right, I align with the fact I need 6 months of an emergency fund in an account. If I'm saving up for that and then something happens to me and I pass away and I'm not able to reach my number or whatever, even if I reach my number, the reason I love life insurance is because it's what I call self-completing plan, right? Because if I'm saving up, and let's say I'm saving $1,000 a month to get up to that number, I'm saving that $1,000 a month, 6 months down the road, it happens. Well, let's say I make $100,000 a year. I need $50,000 in that fund. That's going to take me about 4 years to save up at $1,000 a month to get to that 6 months emergency fund. Well, 6 months, 2 years in, if I die, I got $24,000 in that account. But that account is going to be taxable for the most part, unless it's going to my spouse, of course, and she's just going to take over that. But the bottom line is, I got $24,000 sitting in an account. And that's it, right? Like, and whatever other investments that I have. Whereas if I were to save this in a whole life policy at $1,000 a month, let's just call it $12,000 a year. If I were to utilize this for that, well, I'm going to have a tax-free death benefit associated with it. And let's just say that tax-free death benefit is about $500,000. And if I can make that happen, well, if something happens to me, instead of getting $24,000, Now I got $500,000 going to my spouse, going to my family, going to a charity that I want to support, going to make sure that my kids' college is taken care of, going to make sure that, once again, what I want to happen will happen when I want it to happen, whether I'm here to see it or not. And so that is the big thing. The tax-free death benefit component of this is huge. And I think even though we like to focus on the cash value element of everything, I think it's important that we do start with the fact and understand that this is life insurance, and we can't step past the benefit that that life insurance brings to the table. And so that's the first thing. The second thing, I'm going to continue this conversation because I've already started it, is the fact that we have a liquid emergency fund, right? And so what I want to do here is I'm actually going to go to my board and go like this, and let's get into this. So I want to go to my board here and talk and use this as an example, right? And so a lot of people will start off and they'll say, all right, let me actually go here. Let's just go here and say, all right, a lot of people start off, let's say you're 36 and you want to pay 10,000-ish premium, right? So what are the options? I could save, and this is kind of going back to what I was saying before with the tax-free death benefit. Obviously the death benefit here is $171,000 in this instance, right? Now, this is optimized for cash value. There are different things. If you want more death benefit, we would absolutely focus on bumping that up or getting a term policy to supplement the life insurance need. Once again, I don't think you should step past the importance of the life insurance. And a lot of times people do that too often, and that's a really sad occurrence in my opinion. So we need to make sure we look at that. But when we look at this just from an emergency fund perspective, and we look at the emergency fund side of things and we say, all right, we have $8,953 out of the $10,137 of premium that we paid. So what does that mean? That means that we can build this, we can have that $10,000 in premium, we have the liquidity of the almost $9,000, and by year 10, you can see we've paid in $101,000, we have $115,000. So if, let's say we're earning $100,000 a year, this is going to be able to be our emergency fund, and it's going to help fulfill that. And as you can see, as the cash value went up, so there too did the death benefit. And so there is a just kind of a win-win situation. And so that's going to help you accomplish your goals. Now, once you get past the emergency fund, now we need to think about it in terms of what is our opportunity fund. So the third thing is the third way I like to utilize life insurance. I'm going to recap here a little bit. The first reason is because of the tax-free death benefit, the fact that it's a self-completing plan when you save properly. The second fact is that it's an emergency fund on steroids. It's a bank account on steroids. And so if we know that it's going to outperform our bank account, we want to, over a long period of time, and you can see year 10 here, it's going to do so. Plus, you're getting your dollars to perform multiple functions, and I'm going to get into other ways that it is also working for you at the same time. So we have that through the emergency fund. Now, if we're making $100,000 a year and we need to get to this $50,000 mark, you can see year 5, just like we would have in a bank account, because we put in $50,685 and we've got $50,879, plus we have the life insurance. So once again, this is just leverage. We have the emergency fund taken care of if you believe that you need 6 months. Now, I would argue you need more than 6 months for an emergency fund, but let's just say you need 6 months for the sake of argument. The next thing you need to focus on is what I call an opportunity fund or a cash flow hacking fund. I'm a big believer. Everybody needs to be investing for cash flow and needs to be focusing on creating residual passive income through real estate, through business, through other assets that will do so for you on a predictable basis. That is not what this video is about. I will get into other videos talking about all the different types of passive income vehicles that you can invest in. But when we talk about every dollar that goes in above and beyond, when we start looking at year 6 through 10, now we've gone beyond, assuming you need 6 months of income and you're earning $100,000 in an emergency fund. Now, every dollar that goes into this, you're not going to want to stop saving because of the fact that you hit your emergency fund status, quote unquote. You're going to want to keep contributing because now what you're doing is you're capitalizing an opportunity fund. And this is what I call the cash flow hacking fund. This is where you're going to be able to leverage this for cash flow investing opportunities, whether it's through business or real estate or anything of that nature. You can see, once again, you need that safe, liquid, accessible capital, and by putting this money in your policy rather than putting it in a bank account, It's growing, it's more efficient. You could see by year 15, you put 152 in, you got 195,000, and you have the $500,000 death benefit. Now, that is what it's all about. Now, on the other side of things, if you are in a situation where you have a lump sum of money, maybe you save money in a bank account and you're like, wow, Chris, it's great. I already got my emergency fund. I've already got an opportunity fund kind of started. And I'm going to say, well, where is it sitting? And you're going to tell me it's sitting in a bank account. And I'm going to say, well, let's take a look at that. And let's say you had $100,000 and you want to contribute $10,000 a year. You could do $110,000 the first year, of which you can see 101,000 liquid, and look at the death benefit that you get with that. That's pretty solid stuff. You could see year 2, you contribute $10,000 and the policy grows by more than you're contributing, $10,953. And by year 10, you can see you've put in $200,000, you got $227,000, and you got a $1.9 million death benefit. This is really, really powerful stuff. So this is just a bank account on steroids. If you're comparing life insurance to an investment, you are comparing the wrong things. This is a savings account alternative, but it's a savings account with leverage. So in recapping, looking at this, you got the tax-free death benefit, you got the emergency fund alternative, you have a cash flow hacking fund or an opportunity fund, and then you have the fact that you can do things like controlling your medical directive. So what happens here is, as you see this, and what I'm gonna do is I'm gonna go here, as you see your premiums going down here, what happens is this death benefit, you have access to this money while you're alive. And what happens is, if you become chronically or terminally ill, meaning you lose the ability of 2 of 6 daily activities, living activities, abilities, or you become terminally diagnosed with cancer or some other diagnosis that basically says you're gonna die in the next 24 months, typically, then you have access to the death benefit while you're alive. And it's a portion of the death benefit, and it all depends on when you're alive. But what I can tell you, like in this instance, if you had $1 million death benefit right here at 61 years old and you were diagnosed with cancer, you're gonna have hundreds of thousands of dollars right here that you have access to leverage and utilize while you're alive as a tax-free benefit to cover your, I'm realizing you can't see that. I apologize, guys. But as you go through this and you see this $1 million, you're gonna have hundreds of thousands of dollars accessible at age 61 to be able to do this, right? And have access to that to be able to leverage as a tax-free death benefit while you're alive to control your medical directive, right? Because here's what I know. A lot of times, and I experienced this with my father-in-law, I share this story a fair amount. A lot of times people get involved, in just saving for their future, and they haven't really thought about like what's going to be required of them in retirement. What happens when your health fails? Because I hate to break it to you. I mean, I'm 42. I'm extremely healthy. I work out. I'm really intentional about how I eat. I try to be active. I try to be as intentional as possible, but at the same time, when I'm 70, 75, I understand things happen, right? Like there are things that are gonna happen in our life. Our health is gonna go on us at some point in time. The only thing guaranteed in this is we're not getting out of this thing alive, and there's a 70% chance that you're gonna need long-term care while you're alive, even the healthiest of us. It's gonna happen in some way, shape, or form. And so what I know is I wanna be able to control my medical directive. I don't wanna have to follow the traditional standard medical practices and only do the treatments that insurance is going to allow me to do, where I'm not going to be in control and in power of the decisions that I make around my health. By having a policy like this, not only are we going to be able to have it in retirement to be able to access this money if I want to utilize it as a volatility buffer for any kind of tax-free income or anything like that, but I could access my death benefit while I'm alive if I get diagnosed with anything, so I can utilize it to optimize my medical directive. And see, to me, that's a really, really big deal. And maybe that doesn't matter as much to you, but I've seen it, I've lived it, I've seen clients go through it, I've had personal family members need to utilize it and leverage it. And when you see it for the first time and you experience that, it changes your perspective on everything. And when you realize that you have family members that are alive a couple years later after being diagnosed with something that was supposed to kill them in 90 days, and had they followed traditional chemo and radiation and all that stuff with pancreatic cancer, and they would have been dead, only to realize that they were able to afford alternative treatments and spend multiple six figures because they had access to capital, because they didn't have to worry about it, and they could just follow a path of survival that was in alignment with their values, that was in alignment with what they felt they needed to do for their body, and they didn't just have to follow blindly the kind of Western world way of handling these things that, unfortunately isn't always in the best interest, and I know I'm probably going to get some pushback on that, but that's just how I feel. So if that's a value of yours, I always kind of tell people you need to align your money with your values and beliefs. If controlling your medical directive is a value of yours, if you don't want to be having your health in your future beholden to the insurance companies and all that stuff, you need to put in place a plan that can be in control of that. Now, a lot of people think about disability and long-term care, but the bottom line is, chances are you're going to need this at some point in time. You're going to need something like this, and the younger you start, the better off the benefit's going to be. And it's a great way. Once again, when I talk about performing multiple functions with your dollar, think about this. The dollar, it works as a tax-free death benefit. You then, at different phases of your life, the whole life policy is going to grow with you. You always have the death benefit. You use it to build your emergency fund. Okay, you hit that stage, you complete that task. Now you have your cash flow hacking fund, your opportunity fund. Okay, that's great. Now you hit later in life and you have it, so it's going to be there for your medical directive. Now, each stage of the way, this financial product solves a different problem in your life. I don't know if you realize how powerful that is, but there's not another financial product in the world that's going to do that for you. And that's really what this is all about. Now, when we take that, also in that phase, we're going to get into number 5, and it kind of, this is multiple phases, I suppose. But number 5, and the fifth reason, the final reason that I want to talk about in this video, is just how whole life insurance will help you increase your financial efficiency. Whether it's during the emergency fund, it's once again performing multiple functions, so that is increasing your efficiency. Whether it's the opportunity fund and borrowing against your policy and using leverage in the policy, through the policy, to be able to make your real estate investments better. That's leverage. It's more efficiency, like anything else. When it's in retirement, the fact that you have access to all that capital, you can utilize it as a volatility buffer. That's going to make your other investments better. That's efficiency. You can utilize it for your medical directive. That's efficiency. Anytime we can get $1 to perform multiple duties, that is increasing our financial efficiency. And that is why I believe whole life insurance, a properly designed whole life insurance policy, should be the foundational financial product, financial tool that every single family utilizes in their life. We even have a debt elimination program that shows how you can utilize whole life insurance to help you eliminate that debt, and then ultimately have an asset, not just have your debt paid off, but have an asset at the end of the rainbow when the debt is paid off. So if you have any questions, go ahead and comment in the comment section below. Hopefully you found this valuable. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon.